Good morning for this Thursday, October 31st. Happy Halloween, everybody. We are looking at the chart of UA, stock chart UA, Under Armour. And if you recall, I think I had a pretty good lesson for you yesterday on how I re-entered this trade after getting stopped out with a pretty tight stop there. I re-entered the market on an intraday basis. And if you recall, I went long at $80.38. Okay, $80.38. Now this upper white horizontal line represents pretty much the first profit target at a price of $82.71. Looking to make $2.33. Okay, and the initial catastrophic stop loss on that is the lower white horizontal line, which is at a price of $79.59, risking only 79 cents to make $2.33. That's a real good risk to reward ratio. That's a 3-to-1 reward to risk ratio here. So the market's kind of selling off right now. We're trading at about $80.26, down about 12 cents on the trade. But again, our catastrophic stop loss is right down in here, risking 79 cents, looking to make $2.33. So we've still got this trade going. It's $80.36 as we speak, so we're down only 2 cents, pretty much break even. So we're going to watch this. Okay, there I believe is a good lesson to learn on the Australian dollar, US dollar chart. And let me show you what that lesson is and how you can use 2 time frames to really time your entries pretty well. Now, this is, again, a forex currency pair. Symbol AUDUSD. AUDUSD. Okay, this is the daily chart right now. Now, on the daily chart, as you can see, the trend was down. The bars were red, denoting a downtrend. And every time it pokes its head up in between the blue action zone here are all logical sells. Okay? Now, as you see right in here, the trend turns from down to up, right? Green bars are up. So the first pullback into the gray action zone in here was a nice buying opportunity. A buying opportunity, market came up, hit 200 moving average, 200 exponential, a little higher here. Now, take a look at this and look at how I use 2 time frames, okay? The daily and the weekly, right? Now look at this. On this time frame, on the daily chart, we've got a bearish engulfing pattern. You see that? The high took out the prior bar's high, the low took out the prior bar's low, closing the bottom quarter. Okay? This occurred last week, last Wednesday, October 23rd. Okay? So remember that. October 23rd, we had a bearish engulfing pattern on a daily. Now take a look at a weekly chart. Look at where we are on the weekly chart. Okay? This is last week. Right? Now look at, on a weekly chart, the trend turned down, right? Green bars turned to red right in here. We broke down through the 200 exponential moving average and the bars turned red. Look at market pulled up, blue action zone moved a little higher. Look at the 50 exponential right in here and the 200 exponential right in here coming together right there. Okay? So that is obviously a very logical resistance level where you'd be looking to go short on a weekly time frame. So at that point, when the market rallies up into this resistance area in a downtrend, you're looking for any reason to go short off the daily chart, off the smaller time frame. So once you saw the market pull up into this zone and you immediately flip to that daily time frame, you see the bearish engulfing pattern. So the bearish engulfing pattern off the daily chart actually triggered the trade to go short last week on the close of this bar. Okay? Even though the daily is up, you could go short right at the close of the bearish engulfing pattern of the next bar, and you'd be looking to take this market down to a logical support zone in the daily. On the daily, right? The blue action zone. Somewhere in here, you'd be taking profits off the table, and you'd be bringing your remaining portion of your position to break even. Okay? Even though the weekly is down, the daily is up. So you've got conflicting signals there, but you can obviously see how the daily and weekly can go hand in hand. So again, the weekly chart is down and it rallied into a logical resistance area. Now look for any reason to go short off the smaller time frame. So if you're looking at a weekly, you look at the daily. And again, the bearish engulfing pattern. You want to take this market down to a logical support zone right in here. Take something off the table, move the remaining portion of your position to break even, and that's how you'd be trading this. So again, that's how you use multiple time frame analysis. Of course, if you're looking at a daily chart, you could go, let's say, down to a 60-minute chart and do the same thing. So hope that helps. Have a profitable day and have a great Halloween. Bye for now.